Canada's universal healthcare system makes many believe that Canadians pay a fortune in taxes, especially compared to their American neighbors. Taxes in Canada are a complicated thing, and even many Canadians do not realize how much of their income directly or indirectly gets taken away from them. My research showed me how complicated and confusing this system is, so to make it simpler, let's look into the life of Laura. Like more than a third of Canadians, she lives in Ontario. She is a lawyer and is a part of the 11% of Canadians who make more than $100,000 a year. When people talk about taxes, the first thing to pop into our minds is income tax. And they are not wrong, as income tax is one of the first things which gets deducted from our salary. Like every other Canadian, Laura's income taxes are split into two types, federal and provincial. Federal tax rates apply to every Canadian regardless of where they live, whereas provincial tax rates vary from province to province. The common thing about both of these tax rates is that they are charged to us marginally. It's a progressive tax system where the tax is calculated from the lowest bracket, and once that bracket limit is met, it keeps on moving up as you keep making more and more money. Here are the tax brackets for both federal and Ontario income tax. Because of the marginal tax system, Laura's federal taxes will be calculated at 15% for the first $53,359 of her income, and then at 20.5% of the rest of her income, as the second bracket limit is more than what she makes in a year. This doesn't mean that when she starts making more than $107,000 a year, all that income will be taxed at the next rate of 26%. Only the amount over the tax bracket limit will be taxed at the higher rate. Based on Laura's income, she will be paying about $14,300 in federal taxes and about $7,200 in provincial taxes. This leaves her with a little over $78,000 as after-tax income. As you can see, which province you live in while making the same $100,000 makes a massive difference on how much money you take home after tax. On a typical Canadian paycheck, the next thing which follows income tax is CPP and EI premiums. These tax deductions pay for the Canadian pension plan, giving you a steady income when you retire, and employment insurance, providing temporary income when you are unemployed and looking for jobs. By making more than $67,000, Laura is already over the max amount payable, which will cost her about $4,800 a year in CPP and EI premiums. So this $73,000 in change is actually what hits her bank account every year, and a lot of people think that that's the end of taxes. But no, there are multiple taxes which Canadians pay on top of this, with the biggest being sales tax. Every dollar of that take-home pay Laura spends is subject to sales tax, which is added to the sticker price of basically every good and service we spend our money on. There are certain expenses like most grocery items, insurance premiums, mortgage interest, rent, and so on, which Canadians don't have to pay sales tax on. Housing and groceries are some of the biggest expenses for Laura, which means about 50% of her expenses are sales tax exempt. Sales tax is also made up of federal and provincial taxes. See, certain provinces have strong industries which allow them to not charge additional provincial sales tax, leading to the overall sales tax ranging from 5 to 15% across the country. As Laura is living in Ontario, she is paying 5% in federal and 8% in provincial sales tax. This 13% tax on her expenses takes away almost $4,800 from her every year. The sale tax-exempt expense of housing is still not really free of taxes. Laura owns a very modest apartment in Toronto, which nowadays costs at least $500,000, and based on that, her typical annual property tax will be just over $3,300 a year. I think property tax is still utilized more efficiently than income tax, and we can see that by a breakdown of everything paid for by Laura's property tax bill. In 2017, one of Canada's newest and most controversial taxes was introduced, named carbon tax. The carbon tax aims to increase the cost of fossil fuels, which are dangerous for our environment. Unlike the taxes we talked about earlier, calculating how much we pay in the carbon tax is very difficult. Some things like your utility bill might just clearly show how much you pay in carbon tax. But other things like groceries, gas, jet fuel, and plastic items increase in price as the manufacturers already were charged the carbon tax. Considering all of that, on average, people pay about $478 a year in carbon tax in Ontario. The reason this is higher in other provinces compared to Ontario is because they might depend more on the polluting oil and gas to fight the harsher winters. Provinces also have a fuel tax, which is charged on top of sales and carbon tax. It goes from 0 cents a liter in Alberta to 27 cents a liter in Vancouver. For Ontario, the rate is 9 cents a liter, which for a typical yearly use of 1,200 liters leads to Laura paying an extra $109 in taxes. But looking at every tax we discussed, Laura's healthy $100,000 income turns into $65,000 in change. That's more than 35% of her income gone to taxes, which makes things very difficult as Canada becomes more and more unaffordable. How is this tax rate compared to your taxes? If you enjoyed the video, please like and subscribe. Thanks for watching.